Every crisis begins long before anyone notices. To understand why December 20th mattered, why vaults are draining, why options expirations now shake the system, and why silver refuses to behave like a normal commodity, we have to go back. Not months, not years, centuries. Because the global silver squeeze did not start in December. December was only the moment the pressure became visible. The real story begins with how silver was slowly transformed from money into an illusion. Silver before the system. Real money, real limits. For most of human history, silver was not an investment. It was money itself. Long before central banks, derivatives, and electronic exchanges existed, silver performed three roles flawlessly: medium of exchange, store of value, unit of account. Empires trusted silver because it could not be created at will. You had to mine it, refine it, transport it, protect it. That effort imposed discipline. And discipline is exactly what modern financial systems dislike. Rome's first warning. The Roman Empire began with nearly pure silver coinage. As military spending increased and resources stretched thin, emperors did something subtle. They reduced the silver content in coins. At first, nobody noticed. Then confidence cracked. Prices rose, trade weakened, social unrest followed. Rome did not collapse because it ran out of silver. It collapsed because it pretended it hadn't. That lesson was learned, then ignored. Silver as the backbone of global trade. For centuries after Rome, silver ruled global commerce. China demanded silver for taxes. Europe needed silver to trade with Asia. The Americas supplied silver through brutal extraction. Silver linked continents. But here's the key detail most people miss. Silver shortages always appeared suddenly, not gradually. Everything felt stable until it wasn't. And when silver disappeared, trade froze. The modern break. When silver was demonetized. The 20th century changed everything. First gold, then silver. Governments realized something dangerous. Hard money limits power. So silver was slowly removed from coins currency backing monetary systems. By the late 1960s, silver coins were debased. Convertibility ended, fiat systems took over. But silver still had a problem. It was still too honest. So the next step wasn't removal. It was financialization, the birth of paper silver. In theory, futures markets exist to help producers hedge, stabilize supply, reduce volatility. In practice, something else happened. Silver futures became a way to sell silver without owning it. Then came options, swaps, unallocated accounts, ETFs. Each layer created claims, not metal, and claims multiplied faster than silver could ever be mined. The critical shift. At some point, silver stopped being priced by physical availability, mining output, industrial necessity, and started being priced by derivatives, leverage sentiment. That moment changed everything. The fractional silver system. Today, silver trades under a fractional reserve model, just like banking. Here's how it works. 1 ounce sits in a vault. That ounce is owned by multiple parties. Each believes they can claim it. Most never try. As long as investors roll contracts, ETFs settle in cash, industrial users don't panic. The system functions, but it has a fatal weakness. It assumes trust forever. The hidden ratio. Nobody talks about estimates vary, but many analysts agree. There may be 100 to 300 paper ounces of silver for every physical ounce available for delivery. That is not a market. That is a confidence game. And confidence is fragile. Why this didn't explode? Earlier, a fair question. If this system is so unstable, why hasn't it collapsed already? Because silver has one unique trait. It is quietly consumed. Unlike gold, silver is used in electronics, medical devices, solar panels, defense systems. And once used, it's often gone forever. That allowed paper markets to hide shortages for a while. The calm before the pressure. For decades, the illusion held. Prices stayed low. Volatility was controlled. Media dismissed silver as boring. But behind the scenes, above-ground inventories shrank, government stockpiles vanished. Mining output stagnated. The system survived by doing one thing: selling the future. Again and again and again. Why options matter more than people think. This brings us to options. Options are not just bets. They are promises. A promise that silver will be available, deliverable, replaceable. Most of the time, options expire quietly, but occasionally they collide with reality. And when they do, everything upstream feels the stress, which brings us closer to December 20th. But before that breaking point could occur, something else had to change. something no paper model could control. Demand, a silent shift no one priced in. For years, silver was treated as a volatile investment, a speculative metal, a cousin of gold. But quietly, behind the noise, silver was being reclassified by reality. Silver was becoming infrastructure, not in headlines, not in public debate, but in factories. Silver's new role in the 21st century. By the early 2000s, silver was no longer optional. It became essential for high-efficiency solar cells, electric vehicle power systems, medical sterilization and diagnostics, military electronics, telecommunications, semiconductors. Here's the crucial detail. There is no economically viable substitute for silver in many of these applications. You can't just switch metals without losing performance. That means demand is inelastic. When price rises, consumption doesn't fall. That is dangerous for a paper market. The supply side that couldn't respond. Normally, higher demand triggers higher production. But silver has a problem. Over 70% of silver is mined as a byproduct of copper lead, zinc gold. That means silver supply does not respond to silver prices. Mines don't open because silver rises. They open because copper or gold economics change. So while demand surged, supply stayed flat. The structural deficit begins year after year. Industrial consumption rose. Investment demand fluctuated. Recycling plateaued. Mining output stagnated. The gap was filled how? By inventories. Vaults, stockpiles, above-ground reserves, metal that had taken centuries to accumulate, and no one talked about it. Why prices didn't signal danger. Here's the paradox that confused everyone. If silver was in deficit, why didn't prices explode? Because price was no longer set by scarcity. It was set by leverage. Paper silver could be created instantly. Physical silver could not. So instead of price rising, paper supply expanded. This masked the shortage, but it didn't remove it. The rise of the derivatives engine. As industrial demand increased, so did futures open interest, options volume algorithmic trading, high-frequency liquidity. Silver became a financial product, not a resource. Banks learned they could short aggressively, hedge with options, roll positions indefinitely. As long as physical delivery remained rare, the dangerous assumption. The entire structure relied on one belief. No one will ever demand enough silver at once. That belief shaped risk models, inventory planning, delivery requirements. But history warns us, markets don't break from averages. They break from extremes, early cracks in the illusion. Long before December 20th, signals began flashing. They were subtle, easy to ignore. Rising physical premiums, longer delivery times, growing east-west price gaps, ETF inflows without matching metal additions. Each sign was dismissed. Together, they told a story of metal quietly leaving the system, the Shanghai signal. One of the most important warnings came from the east. In Shanghai, physical silver traded at premiums. Delivery was prioritized, paper leverage was limited. Prices began to diverge, not dramatically, but consistently. That divergence mattered, because arbitrage only works when metal exists. 2.10. Why institutions stayed silent. You might ask, why didn't big players warn the public? Because institutions benefit from stability. Acknowledging shortage would spike prices, break hedges, trigger delivery requests, expose leverage. Silence was safer, until it wasn't. The role of options in the rising pressure. Options amplified everything. They allowed massive exposure with little capital. Delayed settlement, strategic pinning of price. But options have one flaw. They expire, and expiration forces truth. When contracts expire, someone must deliver roll or settle in cash. The more pressure built, the more dangerous expirations became. The setup for a breaking point. By the time December approached, inventory buffers were thin. Industrial demand was locked, and futures positioning was extreme options. Exposure was enormous. The system had one option: survive expiration at any cost. That cost would be invisible, but not insignificant. And when December 20th arrived, the pressure finally met the promise. December 20th, options, expiration. Systems don't collapse in chaos. They fracture in silence. December 20th did not arrive with sirens. There were no emergency press conferences, no trading halts announced in advance, no headlines warning of danger. To the outside world, it looked like just another options expiration. But inside the silver market, every assumption was being tested at once. Why options? Expirations matter more than prices. Most people watch price. Professionals watch expiration. Because price can be managed, expiration cannot. Options are not opinions, they are obligations. When they expire, the system must reconcile. Paper promises, physical availability, balance sheet reality. December expirations are especially dangerous because they close the year, they expose inventory accounting, they collide with tax and regulatory reporting. December is when truth leaks out. The setup. Nobody talked about. In the weeks leading into December 20th, open interest was unusually high. Large call positions clustered near key strike levels. Commercial short exposure was elevated. Vault inventories were already declining. This created a fragile structure. If prices rose, shorts faced delivery risk. If prices fell, physical demand accelerated. There was no safe direct. The hidden constraint, physical delivery capacity. Here's what most analysts ignore. The silver market does not fail when metal runs out. It fails when delivery confidence disappears. The system only needs enough metal to satisfy expected deliveries, but December brought larger than normal standing for delivery, industrial buyers locking supply, eastern markets pulling metal east. The margin for error shrank. The vault drain accelerates quietly. Registered inventories declined. Eligible metal failed to convert. Withdrawals exceeded deposits metal was leaving, and it wasn't coming back. This wasn't panic, it was planning. The critical moment, expiration week. As expiration approached, something unusual happened. Contracts closed early, positions were rolled aggressively, liquidity thinned at key levels. This behavior wasn't random, it was defensive. Participants were reducing exposure, not because of price, but because of delivery uncertainty. Why prices stayed contained? Here's the paradox that confused observers. If stress was rising, why didn't silver explode upward? Because containment was the objective. Large players deployed. Heavy paper selling strategic option, pinning algorithmic pressure near settlement. The goal was simple: survive expiration. Not fix the problem, not restore balance, just survive. Cash settlement, the silent release valve. When delivery risk rises, the system uses its quietest tool. Cash. Offers are made. Incentives increase. Settlements shift away from metal. To the public, nothing changes, but each cash settlement leaves one less ounce backing the system. Confirms metal is scarce, increases future risk. It's a release valve, and release valves weaken structures. Signals only insiders. Watch. While headlines stayed silent, signals flared. Sudden drops in open interest. Rising lease rates. Temporary backwardation flickers. East-west price divergence widened. None of these make news, but together they tell a story of stress. The moment the system exhaled. December 20th passed. No default, no chaos, no announcement. From the outside, it looked like nothing happened, but survival came at a cost. Metal was gone. Confidence was thinner. Leverage increased. The system didn't break. It aged. And aging systems fail faster the next time. Why December was different from every expiration before? Because the buffers are smaller now. Because demand is stronger now. Because trust is weaker now. Each expiration becomes more dangerous than the last. December was not the peak. It was a warning shot. The illusion of stability. Markets reward calm. But calm can be misleading. Just before collapse, stress appears manageable. Prices behave normally. Experts dismiss concerns. That pattern repeats throughout history. Silver is no exception. The question. No one asked. After December 20th, one question remained. What happens when the next expiration arrives? With even less metal. Because nothing was solved, nothing was replenished, nothing was reset. The system moved forward with higher leverage, lower trust, less silver, and that leads us to the aftermath. Every system has a breaking point. What follows is the test of ingenuity or denial. December 20th passed quietly, at least in public view. But the silver market did not breathe easy. What happened behind the curtain would shape the future and reveal why paper promises can never fully substitute for reality. The immediate fallout. Invisible strains. After expiration week, subtle cracks appeared. Vaults continued to drain. Physical silver was being allocated faster than it was replenished. Premiums rose quietly, as in key markets like Shanghai and Singapore. Liquidity thinned. Fewer ounces were available to meet rolling contracts. Hedging became more expensive. Lease rates for silver spiked. To the average investor, the price appeared stable. To insiders, the system was weakened and more vulnerable. The old fixes, temporary solutions. that fail historically, the market responds to stress in predictable ways. Paper expansion, more futures contracts, more options, more leverage, delays recognition of real physical scarcity, works until confidence cracks, cash settlements. Instead of delivery, lets institutions avoid delivering real silver, keeps prices artificially calm, leaves the underlying problem unresolved, regulatory tweaks, exchanges, adjust rules mid-cycle, limit or suspend trading, often designed to protect leveraged parties, not the market. All of these are short-term bandages, not solutions, and they have one inevitable side effect. The next problem is larger. Historical parallels. Patterns repeat. Silver is not the first metal to be manipulated, constrained, or stressed. 1968, London gold pool governments tried to hold gold prices artificially low. Demand overwhelmed supply. Pool collapsed, sending prices soaring overnight. 1980, Hunt Brothers. Silver crisis. Massive accumulation of physical silver prices spiked uncontrollably. Exchanges and regulators intervened mid-market. Result: short-term winners, long-term distrust. 2022, nickel short squeeze hedge funds shorted physical nickel prices, surged 100% in days. Exchange intervened, canceling contracts. Market integrity question, pattern emerges. Real supply pressures clash with leveraged positions. Exchanges and regulators intervened. Short-term calm is restored. Long-term risk increases. December 20th mirrored this pattern, silently, invisibly. Modern parallels: why the system is more fragile. Today, unlike previous crises, today's silver market faces industrial demand explosion, solar, EVs, electronics, semiconductors, long-term, non-negotiable consumption, geopolitical fragmentation. Eastern markets prioritize physical delivery. West remains paper-heavy. Divergent pricing emerges, declining above-ground inventories. Strategic reserves, mostly depleted vaults, cannot replenish quickly. Increased leverage and derivatives, options exposure at record highs, paper silver far exceeds. Physical metal, stress is cumulative. In other words, the system that survived December 20th is weaker than anyone realizes. The next test will be harder. The quiet warning signs. If you know where to look, they were obvious. Rising premiums in Asia versus COMEX, short-term backwardation in futures ETFs, holding paper claims, growing faster than physical metal, lease rates surging for immediate delivery. To the public, this seems mundane. To the insiders, it's a crisis countdown. Why fixes always fail. Attempts to stabilize the market are doomed because they ignore the root problem. They treat symptoms, not supply-demand reality. They rely on faith in paper contracts. They assume trust will persist indefinitely. Every failed fix pushes risk into the next cycle, increases leverage, weakens systemic resilience. History proves this over and over. The key takeaway from the fallout. The aftermath of December 20th is a warning, not reassurance. The market survived, but only because large institutions could manipulate pricing and avoid physical delivery. The system is stressed, with less buffer than ever. The next expiration or market shock, even smaller than December 20th, could be catastrophic. December was a rehearsal. The real performance is still to come. Beyond December, the end game and takeaways. The past warns, the present whispers, and the future tests us. By now, we've traced silver's journey, from real money to paper illusion, from industrial boom to derivative explosion, from December 20th's options, expiration to fragile survival. But the story doesn't end there. It's only moving toward its next stage, the end game. What happens? If delivery fails, the silver market has three potential scenarios. Scenario 1, cash settlements. Normalize institutions avoid physical delivery. Paper, price continues to reflect confidence, not metal. Market survives, but risk accumulates. Scenario 2, two-tier pricing. Emerges physical silver trades. At a premium paper, silver remains suppressed. East and West markets diverge dramatically. Arbitrage becomes impossible. Scenario 3, explosive repricing. Panic for physical silver triggers, massive demand spikes, prices realign with scarcity. Systemic stress spreads to other commodities and financial instruments. History suggests scenario 3 is the most likely if the system's buffers continue shrinking. Modern parallels and shocking data. Consider this. Global industrial silver demand is over 1 billion ounces annually. Above-ground silver inventories are under 500 million ounces. Paper silver claims exceed 100x physical metal in some markets. ETF inflows continue to grow, often without corresponding metal backing. Compare this with 1980. Hunt Brothers' accumulation of physical silver represented a fraction of today's industrial pull, Yet that spike caused markets to crash, rules to change, and distrust to ripple. The difference today? Global dependence on silver is far higher and paper claims far larger. The pressure is unprecedented. 3 clear takeaways. Takeaway 1, paper. Physical contracts and derivatives are not metal. Relying on paper to satisfy physical demand is a ticking clock. Takeaway 2, options. Expirations are stress tests. Each expiration forces truth. As buffers shrink, risk compounds. Takeaway 3, industrial demand is inelastic. Silver is essential. When supply cannot meet demand, scarcity determines price, not speculation. A warning for investors and institutions. If you wait for headlines, you will react too late. If you assume paper claims are equal to metal, you will miscalculate. If you ignore the physics of supply, you will face consequences. December 20th was a rehearsal. The system survived, barely. The next expiration or the next spike in industrial demand might not be so forgiving. Silver does not negotiate. It obeys supply and demand, physics and scarcity. Markets, rules, and regulators can only postpone the inevitable. The question is not if the system will be tested again. The question is, when it happens next, will you be watching or caught unprepared? If this video made you question the calm you see in commodity prices, subscribe for investigative deep dives into markets and financial systems. Like if you believe understanding real supply is more important than paper promises. Comment below. Do you think the silver squeeze is inevitable, or can the system hold another year? Because the story of silver is not just about metals. It's about trust, leverage, and reality itself.